Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing Airbnb stock so we can determine if it's a buy or a sell. Airbnb operates an online marketplace for people to stay at someone else's house or apartment. Most visits are pretty short term, usually a few days. The company acts as a broker and charges a commission from each booking. The name Airbnb is a shortened version of its original name, Airbnb.com. The company is credited with catapulting the tourism industry, although it has been the subject of intense criticism, mainly by residents of popular cities, because it leads to really high rents and a lack of regulation. The company is headquartered in San Francisco, California, and was founded in 2008. The ticker trades on the Nasdaq, Deutsche Börse, Mexican Bolsa, Vienna, Sao Paulo, Buenos Aires, and London Stock Exchange. Let's get started with the model. This is a large cap company, 75 billion market cap. They're trading at $119 a share, and they have 631 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So they were pretty much break even in 2019 in terms of free cash flow. They had a big negative in 2020. It was a down year. 2021 was their first really big free cash flow year, 2.2 billion. And then it jumped up even more to 3.4 billion. So it really seems like this company is hitting their stride. Net income is the profit or loss on the income statement. It's revenue minus expenses. And that's negative in 2019, 2020, and 2021. But they do have a positive in 2022. When a company passes through lots of write-downs, such as goodwill impairment, or impairing a tangible asset like a building or a piece of machinery, that lowers their net income, but it doesn't affect cash flow because the cash left the company when they initially purchased that asset. That's why you might see higher free cash flow and negative net income. Revenue is a sales for the company, and that went from 5 billion to 3.4 billion. As you can imagine, they really suffered in 2020 from COVID, but then it came back strong in 2021, 6 billion, and then it jumped way up to 8.4 billion in 2022. Let's look at their capital structure. 5.5 billion of equity, 2.3 billion of debt. Their net debt is 7.3 billion. Net debt is debt minus cash, so they have about 10 billion of cash on their balance sheet because they could pay down all the debt with the cash on their balance sheet and still have 7.3 billion of cash left over. The WACC is the weighted average cost of capital. That's how much it costs this company to obtain capital. I use the middle one on Finbox, 7.8%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 112 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $99 billion. We divide that by 631 million shares. And we get a calculated stock price of 156. They're trading at 119, so they're trading at a 24% discount. It's a buy according to the model. The website Simply Wall Street is almost exactly what my model is, 156. That's pretty amazing. This is actually the first time I've seen their valuation because I do my entire model first and then I pull their number. 31 analysts priced this stock and the average price target is 142. The low is 98, the high is 185. It looks like this company IPO'd at the end of 2020, and the stock ran up pretty quickly to about 225 at its peak. But usually a stock comes crashing down a few months after it IPOs. It goes up real fast in the beginning, then it comes down a lot. It looks like it bottomed out at about $80. I think that's a low point. I think there's a lot more upside with this stock. The company is really growing, their revenue is going up, their free cash flow is going up, and they have a stranglehold on this market. There are 16 companies in the same industry as Airbnb, and if Airbnb has a number in red, they're worse than the average. If they have a number in blue, they're better than the average. So they don't really spend much in CapEx. They don't need to. Maybe they bought a few buildings for their headquarters, but that's really about it. They don't manufacture anything, and they don't need to buy big ships like Royal Caribbean and Carnival do. So there's really not much of a need for CapEx for this company. They have a really good debt to equity ratio. For every dollar of equity, they have 40 cents of debt. They generate lots of free cash flow. Only booking holdings is more. They rank second in market cap at $75 billion, but they should be number one by the end of the year, possibly next year. They have decent ratios. Price to book is a little better than average. PE is better than average. Price to free cash flow is about average, and their price sales is worse than average. They generate more revenue than the average company. They just recently IPO'd, so we don't have 5 years of revenue for this company, so we can't look at their revenue growth for the past 5 years. And they have a good ROA and ROE. So to summarize, I have them trading at a 24% discount, and I rank their free cash flows 8 out of 10, their revenue 8 out of 10, and their ratio is 5 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.